Hello everyone, this is Dr. Ragvi, and in today's session we will understand what is secondary markets. Secondary markets are markets where securities are resold or traded. Popularly, they are also known as stock exchanges, and they operate as per rules, bylaws and regulations as issued by the government. According to the Securities Contract Regulation Act, under Section 2, subsection 3, any body of individuals, whether incorporated or not, constituted for the purpose of assisting, regulating, or controlling the business of buying, selling, or dealing in securities is known as a stock exchange. The functions of the stock exchange include providing liquidity and marketability, contributing to the economic growth, instant valuation of securities, ensuring measure of safety and fair dealing, induce companies to improve performance. Let us see one by one. Liquidity and marketability of shares which are listed on a stock exchange is ensured as investors can sell them as and when a need arises on the stock exchange and liquidate their money. As a result, this contributes towards economic growth because more money flows towards the productive channels of the economy and the investors benefit by getting higher valuation of the money that they have invested. Further, only those companies attract investment which are good for the economy and contribute in a positive manner, and as a result the entire economy and the country benefits because of this. Further, when an investor makes an investment in a security which is listed on the stock exchange, instant valuation of such securities is possible as the investors are able to find out the daily value of the holdings that they are having, and they can change their positions according to the changing situations in the economy. Further, this also ensures a measure of safety and fair dealing because investors are aware as to what the position of their security is at every given point, and they are able to alter their positions according to the risk profile that they are holding. Further, this also becomes a very good motivator to the companies to improve their performances as only those companies which are performing good attract investment from the investors, and thereby companies also get motivated to improve their performance and attract more investors towards them. Let us see how the development of stock exchange happened in India. In 1865, the brokers in India realized that trading in stocks without rules was full of uncertainty and they needed some sort of a mechanism. So, they together established an organization of stockbrokers known as the Native Share and Stockbrokers Association. It all started in 1855 when an informal group of 12 stockbrokers gathered under this banyan tree, and within 5 years this number of members grew to 60. They established an organization which was popularly known as the Native Share and Stockbrokers Association with 25 members, and 1 rupee as contribution was sought from each of the members. Later, this came to be known as Bombay Stock Exchange. In 1928, Bombay Stock Exchange shifted to the present plot of land. In 1957, BSE became the first stock exchange to be recognized by the Indian government. By then, India was independent, and this became the very first stock exchange to be recognized as a stock exchange by the Indian government. The other stock exchanges also included the Native Share and Stockbrokers Association, which was now known as Bombay Stock Exchange. It was formed in Bombay, now which is known as Mumbai, in 1875. Then we had Ahmedabad Stock Exchange in 1894, Calcutta Stock Exchange in 1908, Madras Stock Exchange in 1937. Over a period of time, because of the lack of transparency in the stock exchanges which were there in India, there were certain problems in the stock exchanges. Among them, the very first problem is uncertainty of execution prices. Now, stock exchanges earlier were not so sophisticated and screen based trading was not undertaken. As a result, execution had to be undertaken on the floor of the stock exchange, wherein you are supposed to approach someone known as a jobber. A jobber would be deciding what would be the price, and that gets reported to the stock exchange, and the stock exchange used to register the price for that particular day. Uncertainty of execution of prices used to be there because the brokers relied on the information given by the jobbers, and the floor of the trading was very crowded and congested, and as a result the prices that were listened to by the jobber was communicated to the broker in turn communicated it to the stock exchange, and an average price of that particular day was decided on that basis. Investors did not have a clear transparent mechanism to ascertain whether the price which is declared by the stock exchange was actually the price which was arrived at by or not. Second thing was that the delivery and settlement periods were very uncertain. Earlier, the settlement cycles used to be T plus 21, that is, trading used to be undertaken on, let's say, the 1st of October. Then the settlement would be done, or the settlement cycle used to be ranged till 21st of October, wherein the investors used to lose an opportunity to make a further investment or liquidate their investments because they were uncertain whether actually the transaction was executed or not. Further, the brokers used to trade on behalf of their client without receiving information from the client. The reason that they used to give was that by the time the client was contacted and the transaction could be executed, a profitable opportunity might be lost. As a result, trading ahead of client was very common in the stock exchanges in the earlier period, which was wrong because many a times traders or the brokers used to undertake transactions for their own benefit and not looking at the client's benefit. Lack of transparency was a very big problem in the stock exchanges in the earlier time because transactions used to be undertaken in a trading settlement cycle of T plus 21. Further, transparency was not very good in the stock exchanges because how the prices were arrived at by the exchange was very unclear and very complicated, and the investors used to not understand how the prices were arrived at. Additionally, because the investors were not able to understand how the stock market used to function, the transaction cost of per transaction was very high, which also make the stock exchanges less attractive for the investors. Risk management was also absent because the settlement cycles were uncertain, the prices were uncertain, and as a result the clients or the investors were not able to manage their risk in an efficient manner, and due to this they used to face huge losses because of lack of information or lack of timely information. Further, the stock exchange was marred by various types of scams, and as a result the investors who are the general public used to say that stock exchange is not a market or not a place wherein the normal people can venture out and do an investment. Club mentality of the brokers or cartel mentality of the brokers also played a very negative impact on the stock exchange and the functioning of stock exchange, because two parties were always at loggerheads with each other, and they used to either drive up the prices or drive down the prices, and in between them the investors or the normal public, normal general investors like us used to face the problems and losses. And off market private deals were a very big thing in the market, because the regulatory framework was not strong. SEBI was enacted, the SEBI Act was enacted in 1992. Before that, there was controller of capital issues only, and the stock exchange used to come under the purview of the government of India. Government of India and the finance ministry had a very big area of operations, and stock exchanges was a small part of it. As a result, there was not much concentration as to how the activities of the stock market can be regulated. Over a period of time, these limitations were identified, and the government of India enacted the SEBI Act, through which stock exchanges came under the direct control of SEBI, and all the intermediaries who are functioning in the stock exchange by result and by default also went under the control of stock of SEBI. In the next lecture, we will continue the discussion further by seeing what was the post-reform scenario, that is, after 1991 reforms were introduced, how did these reforms impact the working of the stock exchanges. Thank you, and we will meet again.